Welcome back, everyone. It's been a minute. This is Tech Tune Up with Paul Meeks. I'm Paul, and it's May 3, 2024. The market has been very turbulent. It's actually a very good day for tech investors today. NASDAQ up about 2% on the heels of Apple's quarterly report last night, which we'll get into, and probably some pretty good, as far as tech investors go, macroeconomic data released. So, you know that we delve into not just the stories of the day in tech, but how they impact these companies, these stocks, and even broader the industries within the tech sector, and even the markets more broadly. So let's get right at it. These are the stocks in the news, and I'll also mention what they're telling us. So first of all, I think this is interesting. Microsoft, since we've last met, had a pretty strong quarter. I was pretty impressed. It's long been on my fresh money buy list. It still is. Particularly good growth from Azure, which is their cloud outsourcing platform driven by artificial intelligence workloads. But I thought the most interesting news from Microsoft was not that, because I expected all the great things that they announced during the quarter, but they're going to spend about $2 billion to build AI infrastructure in, of all places, Indonesia. And Indonesia is interesting because Indonesia is not a small fry, has about 300 million people compared to our 340 million. But this is a trend that is worth watching because all the tech majors, not just Microsoft, are trying to build infrastructure all around Asia, excluding one place that they're trying to escape from, China. So stay tuned. It's very, very interesting. Next on my news is Alphabet. Alphabet had a really good quarter. Digital advertising is back. And we also saw that in Meta's results. But Google's stock actually performed very nicely the day after reporting earnings. Meta got hammered, down 15%. What's the deal? But anyway, I am pretty bullish on Alphabet, and digital advertising should get only more robust as we go through 2024, as we prepare for the presidential election on November 5. Next, we have Meta, and I think Meta is a particularly interesting buying opportunity here because on its quarterly news last week, the stock plummeted 15%, and I don't think it's justified. Everything fundamentally was status quo. Really good report, good guidance. But here's the rub. They said that they're going to spend $40 billion this year on capital expenditures that are AI driven. Now, that is a nuclear arms race that is only accelerating, and of course, only the big boys can play. But the thing that bummed people out, and again, I think it's overdone on the downsides of buying opportunity, is CEO Mark Zuckerberg said that we're going to spend all these dollars. However, don't expect us to monetize AI anytime soon. So heavy capital outlays, much higher than people ever thought, without a return on investment, at least not yet. I actually think this will be just fine over time, probably a buying opportunity. I was very impressed with Spotify's results. You know, Spotify has just thrashed everybody in music streaming. And of course, Spotify, as you may know, trades in the United States, but it's not a US company. Really pulling away. Next is not a quarterly news item, but I thought a pretty interesting item from one of America's largest enterprise resource planning software companies, Oracle. Oracle has been a mainstay of Silicon Valley, California for decades. And they're moving their headquarters to Nashville, Tennessee, of all places. Why? Because this company about a year or so ago spent almost $30 billion to acquire a healthcare IT company called Cerner. Now, so far, no good with this acquisition. Very messy, no revenue uptick. But they are moving to Nashville, which beyond country music is, at least for healthcare facilities, the capital of the United States. We'll see. One of the tells I look for in my tech sector is that the IPO window has opened, initial public offerings. Now, for the tech sector, the IPO window had been slammed shut when tech stocks were doing so poorly in 2022. started to crack open a little bit last year, but now we're starting to see some IPOs come through the pipe. And of course, the test is not only do they go public, but how does the stock do after the IPO? And this data storage company called Rubrik had a successful IPO. Stock is still up. And so this is an encouraging sign for tech investors. Hot IPOs once again. We haven't seen those in a while. The next stock is actually on my you-know-what list. I've never liked Intel. I think Intel is a semiconductor darling from the 90s. It hasn't been relevant for a long time. And then they showed in their most recent quarterly report a couple of days ago that they are really struggling. Now, I think this company is better managed than it has been in a long time under CEO Pat Gelsinger, which came back to the company a couple of years ago. But they have a very ambitious plan to outsource semiconductor manufacturing. I don't think they're going to make any money on that until at least 2030. It's a long time away. In the meantime, I don't know if they're going to be a true player in AI that they say they are. And of course, they sell their CPUs, central processing units, into PCs. And everybody who wants to have a PC at home or in the office has two. And so it's a mature market, and that's really starting to show. This is probably the most interesting story of the day, at least today, Friday, is last night Apple reported earnings. Now, the expectations were very, very low. So probably pretty easy to beat those Wall Street expectations. The stock is up a lot today. It's up about 7%. Best day that Apple has had in a long, long time. But I would tell you this. I encourage you, if you own Apple, to scale out of the position starting now. And I think that next month, they're going to have a developers conference about the second week of June. And at that developers conference, they're going to tout their AI stuff and probably just a bunch of marketing spin. I don't know if they have any game there at all. But anyway, the hyperbole will probably drive that stock back to its all-time high of $200 a share. And at that point, blow it all out. I am not a believer here. Apple hasn't been on my buy list for a long time. The company for about a year and a half, almost two, every quarter is shrinking its revenues. It's shrinking its earnings. The only reason that it has positive earnings per share compares is that it's so aggressively buy back its shares that it boosts almost artificially, financial maneuvering, its earnings per share. You guys, I don't care if it's Apple. You cannot call a company a tech company if it ain't growing. And these guys are not growing. Haven't had a robust growth quarter, top or bottom line, for a year and a half to two. So again, start to sell the stock into strength right here and blow it out at $200 a share. And I think it will get there on this AI marketing spin next month at their developers conference. Next is a tech stalwart that I really like. I really like their quarter. Amazon. I think it goes much higher from here. Amazon had a really nice quarter for Amazon Web Services. The street was expecting increase of 15%. They did 17%. And the nice thing about Amazon Web Services is it's so much more profitable than their e-commerce business. Check this out. So Amazon Web Services is a teens percentage of Amazon's overall revenues, but it's 2/3 of its operating income. And the other business that's growing fast that has such a high margin that is going to continue to boost Amazon's overall margin is its advertising business. People don't realize this, but Amazon's advertising business is so strong that they're probably at this point number 3, only behind Meta and Google in digital advertising. And if you take a look at the business models of Google and Meta, you'll see how profitable that business is. And so as Amazon Web Services continues to grow faster than e-commerce, and the advertising business continues to grow faster than e-commerce, you will have a natural, really big lift in the pound for pound profitability, dollar for dollar profitability over at Amazon. So I'm really impressed. Probably out of all the tech majors, the most impressed with Amazon's quarter. Next, here is Advanced Micro Devices. If you want to play AI semiconductors. Just buy more NVIDIA. That's what I do. AMD, unfortunately, is a bit behind uh, NVIDIA in AI chips. And also, AMD brings to the dance the unfortunate fact that they sell a lot of chips to, again, the very slow, very mature PC business. So I think AMD, may give, at least on the product side of the house, NVIDIA at some point a run for the money. Maybe they can become a dependable number two backup plan B supplier for some of these companies, but they're burdened by some crap as well, some legacy crap. Just buy NVIDIA. I wanted to tell you about ServiceNow. ServiceNow, I am bouncing off the Meeks buy list. You may remember that's there. Still my favorite play in enterprise resource planning software, but their quarterly results announced a few days ago were decidedly mixed. And so, you know what? I tell you, one of the things I do is whenever a company does not beat Wall Street expectations for revenue and earnings per share, we call that a negative earnings surprise. I usually blow it out. Because remember, I've told you this before, the cockroach theory. When you come down to the kitchen in the middle of the night, you flip on the lights to get a drink, you see one roach, but you know there's more roaches if you've seen one. So what happens with these negative quarterly surprise is they usually come in long streaks. They have one, then they have another, then they have another. But then the cockroach theory also works on the positive side. Once a company has a nice positive surprise, like NVIDIA has been doing, it typically triggers a whole slew of them. So the cockroach theory can be positive, the cockroach theory can be negative, but unfortunately, ServiceNow, ticker NOW, negative most recent quarter. IBM, also big blow up, really unimpressive. I'd stay away from that. The only reason you want to buy IBM, at least the 21st century version of IBM, is probably for its dividend yield. It does have one of the juiciest dividends ever paid by a tech company. But I will tell you this, it's a good and a bad thing. When a tech company starts to pay big dividends because it cannot reinvest in its business profitably, that's telling you it's no longer a tech company. It's become a value stock. It's become maybe a business services company. But tech companies need to grow and they need to reinvest in R&D. Another poor report from a company that I follow very closely. It's called Cadence Design Systems, ticker CDNS. It is one of the two in the oligopoly in enterprise design automation software. And this is software that is used to design chips by semiconductor engineers. I very much like Synopsys, one of its competitors. They seem to beat the numbers, quarter in, quarter out. Cadence has now had two negative surprises in a row. I don't know how oligopolists in the same industry, totally dominating the industry, one could do so well, one could do so poorly. Cadence just must be much worse at execution. So an EDA, electronic design automation software, on my list is Synopsys, not Cadence. Tesla, I think, is another company that, I think this one is BS. We've made a very good call on this program to short this stock. Tesla is spinning it like it has never been spun. The quarter they announced last week was absolutely dreadful. Their revenues were down 9% year to year. Their operating income cut by more than half. And what they're promising investors is a lower cost $25,000 automobile, but they don't have any details. And they say that they're not going to have to add to capital expenditures to do that they can actually create these models on their own factories. BS. And then they're talking about autonomous driving, some big autonomous driving announcement coming at the beginning of August. You guys, in 2019, they started talking about autonomous driving. And then Elon Musk goes to China last week and crows about it some more. This ain't new news. If this stock continues to rise, I had covered my short position when the stock was down. I'm shorting it again. Next, Netflix. Here's a company that I actually think is a better buy off of, just like Meta had a quarter in which investors acted negatively after the quarter was announced, but I think it's a buying opportunity. So Meta and Netflix, buy them on their dips. Here's the deal with Netflix. Netflix had pretty good numbers, but they said going forward, actually beginning in 2025, They're no longer going to share on their quarterly webcasts their net subscribers. And when it comes to tracking this company on Wall Street, the number of net subscribers added in any period is probably more important to Wall Street analysts than revenue or earnings per share or even cash flow. And so when you see a company becoming less transparent, that freaks some people out. But it actually doesn't bother me. I think Netflix is a better buy. And I've told you a million times, if you're ever going to stretch and invest in media, hold your nose and keep buying Netflix. Do not be tempted by these legacy media companies that are trying to become Netflix, like Paramount Plus, Warner Brothers Discovery, Comcast, Disney. Just buy more Netflix. My favorite tech stock, Micron. Everybody knows this. It's the leader with 2 South Korean companies in the world in memory chips. And AI has a voracious appetite for these chips, something called high bandwidth memory, HBM. And Micron the other day got $6 billion in CHIPS Act funding. You may recall the CHIPS Act was promoted by Biden in 22, passed by Congress to try to bring manufacturing of semiconductors back to the United States. So Micron's getting $6 billion, but so is Samsung, and that's a South Korean company. So is Taiwan Semiconductor. That's a Taiwanese company. So yes, it's not going to go to all U.S. producers. It's going to go to foreign producers too, but they're going to have to manufacture in the States, and hopefully they hire Americans. Last but not least, kind of a squishy quarter from Taiwan Semiconductor. But again, just like Meta, just like Netflix, I buy on this stock's weakness. Taiwan Semiconductor builds all of the most advanced chip designs from all the companies that just sit in Silicon Valley and design chips. Taiwan Semi has some outsourcing manufacturer of the sophisticated designs, 90% market share. Of course, the risk is Xi Jinping in China decides to take back Taiwan. That would freak me out, but I don't see that. In the meantime, whenever you can, buy TSM, which trades in the United States, the world's most important semiconductor company. So there you have it, guys. Let's take a look at tech picks just next. You guys, as you may recall, I color code my picks to tell you exactly what I'm thinking about in the current moment. We're trying to make this show action-packed, and you can actually get half an hour of Meeks, and you come away with actionable ideas. Not tomorrow, but today. So as we go through my list, these are stocks that I hold. Yellow color means I got kind of stuck at the light, right? I'm waiting for the light to change. I don't know if I want to buy the stock yet. I'm watching it. I'm a little bit curious, but it's kind of in the wait and hold pattern. The ones that are fresh money buys today are in green. I would buy these today all day long. So let's just stick with the ones that are my fresh money buy list. I just talked about the story of Micron. I've talked about it in several of these broadcasts. My top tech pick, ticker symbol MU. I do like Microsoft. I told you why. Pretty impressed with the growth of Azure and all of their AI maneuvers. Of course, they also own 49% of OpenAI. Amazon was my favorite quarter, as I told you, of all the U.S. tech majors. Really surprising growth in their very profitable advertising business, accelerating growth in Amazon Web Services. And it's very nice because these two business units are far more profitable than the traditional e-commerce business. NVIDIA, I continue to like it. I know it's boring, right? I bore the hell out of you. The stock's already up 3 or 4 fold, but this stock is pretty volatile. And there was some anxiety about NVIDIA last couple of weeks. And you can buy this stock at almost any time. If you just stick around, it's going to have a 5 or 10% dip. That's just kind of par for the course. So I would continue to buy those dips. I like the language software company, Duolingo. We talked about that before. Dell is among my favorite plays in AI-centric data servers. Taiwan Semiconductor, as I mentioned, world's most important tech company. Alphabet, I really like the significant rebirth, reacceleration, not just for Alphabet, but for Meta too in the digital advertising business. And of course, unless the US kind of spirals into a recession, which I'm not expecting, that should continue to be relatively strong with a little bit of a kicker about all the digital advertising dollars that will come their way during the US presidential election cycle with the election November 5th. Booking.com. There is, since COVID, a lot of what I call revenge travel. People want to get back out there. It's been the case for the last year or so. And when it comes to these, what we call OTA, online travel companies, Booking is the best. Expedia sucks. Expedia is poorly managed. Booking is very well managed. Plus, Booking has properties in Asia, which are accelerating, and they do better than the US properties. So anyway, I'll buy Booking and I'll short Expedia. What you could do is a pair trade. A pair trade means you go long your favorite stock, that's Booking, and then you go short with the equal dollars allocated to its competitor that you don't like. That would be Expedia. So anyway, that would be a pair trade that I'd consider. And then there's Supermicro. Since we started airing this program a couple of months ago, I have been in, I have been out, I have been in, I have been out. I've told you every trade. We have been playing Supermicro SMCI like a fiddle, and I want to get back in now. The stock has come back. I do think that there was some consternation about their quarterly report. The stock got smacked. It's now starting to come back. But you guys, I'm back in the game with SMCI. Let's now finish up with some tech trends. Remember, I told you it's the 80-20 rule with tech and other aggressive growth stocks. Interest rates go down, stocks go up, and vice versa. 80% of our call is a macro play on rates. 20% of our call is the micro play on the company's fundamentals. And so I'm watching this stuff like a hawk. Like today, the market is huge for our tech stocks. One of it is what I think is an artificial bump, a bullshit bump in Apple. But also this morning, the Fed's announced non-farm payrolls for the month of April. We added in the month of April 175,000 jobs, but the street was expecting us to add 240,000. So why would the stock market be up on fewer people being hired? Are we just insensitive people and we want everybody to be blown out? We actually, believe it or not, are rooting for a softer labor market. And another indication of this is the U.S. unemployment rate crept up to 3.9%, 3.8% was expected. So again, indication of maybe a little softening in labor. And when you have softening in labor, there are less wage pressures. And if there are less wage pressures in this country, then there is lesser inflation. And if there's lesser inflation, our central bank, the Federal Reserve Board, can start to lower rates. And when they do, we will go from having, when rates have been going up the last 2 years, a hurricane wind at our face to a nice hurricane wind at our back. And if you think that we've been making money in tech stocks, and we have on this show, man, that's going to be super bullish. So anyway, this kind of softening in the labor market was something that maybe people are starting to think that Fed Chair Jerome Powell and company can finally get around to lowering rates, because we started raising rates in March of 22. Last time we raised them was July of 23. And now they've plateaued, but they haven't started lowering rates either. And we're chomping at the bit for them to do that. So keep an eye on it. One of the things that did freak me out a little bit last week is last week we got the early indication of GDP, gross domestic product in the United States for the first quarter. Wall Street was expecting our economy to grow 2.4%, but it only grew 1.6%. Now, 1.6%, because it's still growth, is not a recession. A recession is a shrinking economy. But that, if we don't get inflation under control, could lead to what we call inflation, stagflation, right? You have slow economic growth, but you also haven't conquered the inflation beast. I hope that doesn't happen, because that was super nasty in the 1970s. caused a lot of economic pain, a lot of problems in the market. So let's keep fingers crossed, no stagflation. One of the things that blew me away through this whole quarterly reporting cycle in the last couple of weeks is all the tech majors, and I talked about all of them, announced their results, and they are spending an absolute shitload on AI infrastructure. Oh my God, you thought it was big before, they're accelerating. Now, Meta, Alphabet, Amazon, and Microsoft, this year alone, all four of those tech majors are going to spend at least $40 billion, with Amazon spending $60 billion on AI-driven capital expenditures. Who does that benefit? Just buy some more damn NVIDIA, right? The nuclear arms race continues. We don't know if these AI products will ever be monetized, which is a favorite Wall Street term. But we do know that the infrastructure building has amped up. It is accelerating. Meta said we're going to spend 40 billion this year, and then our capital X budget is going to go up 25, 26, 27. So the $40 billion is just the new normal. It's just the baseline. So man, this is interesting. And then last year, so last year's behind us, but venture capitalists invested $22 billion in AI startups. So these are the folks that were building these large language models, investing in the tune of tens of billions of dollars, but they're going to create the magic with the results from those models. I'll believe it when I see it. I'm a little bit worried that AI monetization, not just for Meta, but for everybody, is going to be much less than folks think. And it's going to be pushed further and further back. But in the meantime, it is absolutely certain, 110% guaranteed, that the picks and shovel guys, the semiconductor companies like NVIDIA, the server companies like Dell and Supermicro, unquestionable. You may not like their valuations, and maybe at some point, all the goodies are baked into their stock price and the stocks are too expensive. But oh my goodness, their fundamentals should be absolutely sterling for a couple of years. I think this is kind of interesting. Tech job cuts are continuing, and this is a real potential problem for the commercial real estate market, particularly in the Bay Area of California and other places that are tech hubs around the United States, because we are already, by going post-pandemic to remote working, we're starting to gut some of these offices. Now in the Bay Area, just like I announced earlier, Oracle, a Silicon Valley stalwart for years and years, going from Silicon Valley to, of all places, with its headquarters, Nashville, Tennessee. And so, yes, this could be really bad for some of those tech hubs and all of that empty office space. So to be determined, I'm going to follow it. I just think it's probably a pretty cool tell for our sector. The tech bifurcation continues. This is a real stock pickers market in technology. It is the best opportunity for active managers that I've seen in a long time, because you have some companies that have their positive earning surprises. They give good guidance for the next quarter. Their stocks soar. Then you have other companies that plummet. And so I will tell you, a really good time right now, because I don't really like a market where the tide lifts all boats. There's no differentiation. But right now, a really good time for tech stock picking. But you got to be absolutely precise. Go in with a single rifle shot, not a broad shotgun approach. But if you're interested in following up, these dudes behind me, this is my firm, Harvest Portfolio Management. I run a tech model. You also want to hear some more. I also do another show called Wall Street Beats. You should check it out. It's a lot of dream team analysts. I'm just the tech voice. We have analysts in all the different sectors. Watch out for Wall Street Beats. Last thing I want to mention is, you've probably seen this news. As part of Biden's plan passed through Congress, right, to continue to fund the wars in Israel and in the Ukraine, they threw this bill, as they always do, right? There's always a lot of fluff added to these bills, a ban on TikTok. And this ban on TikTok is going to go all the way to the U.S. Supreme Court. And it is going to be one of the biggest, most important, highest profile free speech cases in American history. Everybody knows TikTok is a Chinese company owned by a company called ByteDance. But TikTok plays a big role in the States. We have 340 million population. 170 million of them are on TikTok. And there's an estimated 7 million US businesses that essentially come to the dance every day in their marketplace solely through TikTok. So this will be a really interesting play on free speech. Probably goes to the US Supreme Court. And it probably doesn't matter if Trump is president or Biden is president next. Stay tuned. I'll report on it because tech and regulations, not just in the United States, but also in the European Union, can play some very important roles. Very important roles. And if the regulation turns against some of these tech leaders, their business models, which have been so successful to date, can be totally upended. So anyway, that's why I'm here. I'll follow all this stuff. We will be back next week, but that's the end of this particular program. Won't be so long next time, but we had a lot to catch up on because we hadn't been on air for a couple of weeks. But anyway, everybody, be well, stay tuned. See you next week.